Hello and welcome back to my 10 favorite people. Hope you're doing well. I'm incredibly excited for today's video because we just had our third ever global liquidity index breakout since Bitcoin's inception, and the first two led to parabolic Bitcoin rallies. We can see that correlation very clearly on this chart. When global liquidity bottomed in early 2015, so did Bitcoin, but once it broke out in early 2016, Bitcoin entered its parabolic phase. When the global liquidity index bottomed in late 2018, so did Bitcoin, but once it broke out in April of 2020, Bitcoin entered its parabolic phase. And of course, in late 2022, we saw the global liquidity index bottom and Bitcoin did soon after. And right now we are witnessing the third global liquidity index breakout since Bitcoin's inception, and it seems highly likely that Bitcoin is going to follow. Now, just to be clear, this index also includes other things outside of just money supply. I know a lot of people call M2 global liquidity, but this also includes things like the Fed's balance sheet, the Treasury General Account, the European Central Bank, the People's Bank of China, and the Bank of Japan, because those central banks and their balance sheets do have a very large impact on financial markets, so they are included in this index. But it's very hard to ignore this correlation we've seen over the past decade between Bitcoin and the global liquidity index. It also helps that this aligns almost perfectly with what we've seen between Bitcoin and the US dollar historically. When we've seen the US dollar index break below the 100 level and enter a downtrend, Bitcoin entered a parabola phase during those time periods as well. And as of right now, we have the US dollar index breaking below 100. There can be some bounces along the way, but it's nice to see that Bitcoin is showing early signs of reacting to the downtrend we have seen in the US dollar index and the uptrend we have seen in global liquidity. And this isn't something we just started talking about yesterday. This is what kept us optimistic during the extreme fear that we've experienced over the past few months. Everybody was panicking over tariffs. Everybody was panicking about negative GDP and Bitcoin is going to 60K, 50K, 40K, but we focused on the data and waited to see what the data would say, and global liquidity combined with sentiment has been incredibly valuable to us this entire cycle, and it worked once again, just like it did in late 2024 when the sentiment was extremely greedy, but global liquidity was telling us that Bitcoin was overdue for a correction, and we just watched the exact inverse happen very recently during the extreme fear we saw in March. But now that we've seen Bitcoin rally a bit, we have sentiment back in the neutral region and optimism is starting to re-enter this market. That's why I called Monday's free weekly report the vibe shift. It never ceases to amaze me how quick sentiment can flip in this market. One moment it's all over, the next moment we're so back, and the exact same people calling for 40K Bitcoin in March are now calling for 200K Bitcoin just a few weeks later. This is exactly why I gave up on investing based on how I was feeling a long time ago. I used to always buy or sell based on the latest narrative, convincing me that we were going higher or going lower, or based on what popular analysts were saying. But now all I do is follow my system that I already have laid out. And whenever it tells me to take some profit, I do so, no matter how greedy I feel. And whenever my system tells me to buy the dip, I do so no matter how fearful I am or no matter how bearish the current narratives are. And now that that's done, I can just sit on my hands and enjoy the ride. If you want to learn more about my portfolio management system, you can check it out in the Crypto and Macro Enjoyers program. We are now in early bird phase 2 as I build out the second course, which is going to have all of my mental models. The first one was released yesterday, and I'm excited to capture everything I've learned and that's helped me over the past 8 years being in this market in these modules going forward. So you can check that out if you're interested. And now I know what you're thinking. Yeah, all of that global liquidity and sentiment stuff is great, but what about this terrible recession that's supposedly around the corner? What about all of this tariff drama that's happening with China? Now that prediction markets are saying that there's a higher than 50% chance we're going to see a recession this year, how is it even possible that I can be optimistic on risk assets? I mean, we literally just saw a negative GDP print in Q1, surely it's all over. But what the media doesn't tell you is that there are two types of recessions and they impact asset markets very differently. We have technical recessions, which is two negative GDP quarters in a row. And then there's recessions that I like to call true recessions, like 2008 or 2001 or the early 1990s. And that's when we see major unemployment and major layoffs. That results in a very dangerous reflexive spiral, and that tends to have a huge negative impact on risk assets. But technical recessions are something the Fed can handle pretty easily because all it takes is some easing and lowering of interest rates to turn it around. So I'm not that concerned that Q1 was negative, especially because a lot of it was due to tariff front running. And as of right now, the Atlanta Fed is forecasting positive real GDP for Q2, but obviously we're still just in the early innings of Q2 and we'll continue to monitor this as we go along. What I would need to see to become incredibly concerned is a spike in the unemployment rate, because that could result in a dangerous loop that would be terrible for the economy and for risk assets, but we are not seeing that right now. We got a 4.2 print on Friday for the unemployment rate, and that matched the prior reading, so we did see the labor market remain relatively stable and in place. And our leading indicator for the labor market, initial jobless claims, which we use as a proxy for the number of layoffs, that has been pretty flat as well. So until I see that spike up and see a huge number of layoffs coming in, the average that has started recessions is about 350,000. Right now we're around 240. So I would need to see a big spike in this metric to be concerned that we're entering what I call a true recession and not just perhaps a technical one that the Fed can easily resolve. And with inflation getting closer and closer to the Fed's target, with our most recent print on core PCE coming in at 2.6%, not to mention our leading indicator for inflation, trueflation, coming in at 1.36 year over year, it's no surprise that the market is beginning to price in more rate cuts. And I think the Federal Reserve is going to be facing more and more pressure to cut rates sooner rather than later, especially with falling inflation and a slowly weakening labor market, not to mention the negative GDP print that we saw in Q1. They've been reducing their balance sheet and doing quantitative tightening for over 2 years now, but that is beginning to slow down and turn around. That's also going to put more downward pressure on the dollar if they do start cutting rates more and start doing QE. And we already talked about how a dropping US dollar index is great for Bitcoin and other risk assets. So it's no surprise that after this big downtrend we've seen in the US dollar index, risk assets like Bitcoin and the S&P 500 are beginning to price that in. We're still seeing very solid inflows coming into the Bitcoin spot ETFs as more and more investors are noticing that Bitcoin isn't being impacted by these US specific issues like tariffs. We also have Bitcoin confirming a major range reclaim by getting back above that 91K level that we've been watching for months now. And as long as it maintains this range reclaim, it becomes way more likely that we're eventually going to break this range to the upside. We're still seeing states all across the US talking about Bitcoin reserve bills and crypto investment bills. And although none of these have passed yet, just the fact that the conversation is happening is quite bullish in my opinion, especially compared to what we've experienced in this asset class in previous years. The chances of Bitcoin revisiting 60K are dropping by the day based on current data. So far, this cycle's price action has been very different from previous ones. Instead of a huge rally like what we saw in 2020 with a very sharp and aggressive drop, this cycle has been a lot more slow and steady, perhaps thanks to ETFs and institutional involvement. We see strong rallies and then long-term holders begin to take profits. Bitcoin enters reaccumulation. Some of those long-term holders start to buy back in with the help of the ETFs. We rally again. Long-term holders sit on a lot of profit, start to lock in some of those profits, and then Bitcoin enters some reaccumulation once again. And now it looks like we're at the early stages of another rally for Bitcoin. And this is making this uptrend and bull market a lot more sustainable compared to the vertical blow-off tops and crashes that we've seen historically. So we'll see what happens. Bitcoin is now over 100% away from its 200-week moving average, which is what I would consider the expensive region. So nothing much for me to do here but sit on my hands and see what happens. And as for this cycle, Bitcoin is back on track with our early cycle scenario. Could this rally carry on until Q4? Maybe, but that's going to depend very heavily on the macro data. What happens with the labor market? How long does it take the Fed to actually step in? And what ends up happening with the tariff situation and the 90-day pause that we're currently sitting through? That's going to have a huge impact on what type of cycle we end up seeing. I'm open to the normal cycle scenario if we do see Bitcoin start to consolidate for a while and have a slower, more sustained uptrend as the macro data remains positive. But if we do lose the 50-week moving average and break down, it becomes a lot more likely that the cycle is over, in my opinion. And that would likely be driven by the labor market falling apart or the Fed deciding to take way too long to pivot their policy and start easing. But I am still incredibly bullish on the future of this asset class. Just this week, the US Treasury said that stablecoins are on track to reach $2 trillion in total market cap by 2028. For over a year now, I've been saying that stablecoins are by far the best product that this industry has produced so far. And this is actually a chart put together by the US Treasury. You can see that 145 billion of market cap is in USDT, another 60 billion is in USDC, and it has been growing very quickly now that we have much clearer regulation and a lot more US institutions are getting involved in these stable coins, and everybody is seeing how much money Tether is making. They posted $1 billion in profits in Q1, and it's only a matter of time before every major financial firm or US institution launches their own stablecoin because of just how profitable this business model is. So it's only a matter of time before Tether faces way more competition from USDC and others. And I can't be long-term bullish on stablecoin adoption without being bullish on Ethereum, whose price action looks quite decent after that false breakdown we had below 1500. We are seeing full capitulation in the MVRV Z-score for Ethereum. Everybody has essentially given up hope. And the Ethereum Bitcoin pair is back to where we fully had our reset and bottomed in the 2019 bear market. So I'm seeing quite a bit of relative value for Ethereum here. It's also nice that sentiment has completely gone down the drain on this asset. So we'll see what happens. And because Solana is Ethereum's main competitor, I'm bullish on Solana as well, especially when it comes to stablecoin adoption. Beautiful false breakdown below the 120 level, beautiful retest of the 200-week moving average, and it's now working its way back towards its range mid. We now have the Bloomberg analysts boosting Solana's ETF odds to 90%. So I'm curious to see what those inflows will look like, because Ethereum and Solana are some of the best ways we have to get exposure towards stablecoin adoption as of right now. And Solana Bitcoin looks pretty solid as well, bottomed on the December 2023 lows and now trying to put in a higher low before working its way higher. So we'll see what happens. Bitcoin is still leading the pack in terms of how it's doing compared to our benchmark, the S&P 500. Solana is break even over the past year, and Ethereum is still trying to make back its losses. But now that we've seen this range reclaim on Bitcoin, as long as it holds above our range low at 91K, I think that's going to be a great backdrop for Solana and Ethereum. And the rally we've seen in the S&P 500 should be a nice backdrop for risk assets as well. But as we look forward, we still have the federal government running huge deficits. That trend only seems to be worsening. Yes, Doge is reducing a little bit, but compared to the deficit we're currently facing, it doesn't seem to be making that big of a dent as of right now. And as long as we continue to see parabolic debt growth, I expect the money supply to go parabolic as well, which will devalue the fiat currency. And since we price our risk assets in fiat currency, I remain bullish on popular risk assets like the S&P 500 and fixed supply risk assets like Bitcoin. But as always, thank you so much for the support on the recent videos. Thank you so much for watching, and I'll talk to you soon.